Hello and welcome to Startup Street. I'm Arundhati Ramanan, and with me as always Shruti Mishra and Ritu Singh. These are the top headlines from the startup world. Motilal Oswal and Raamdeo Agrawal acquire $50 million in Zepto shares each. Move boosts Indian ownership in the startup ahead of its IPO. Motilal Oswal also eyes an additional $250 million in a secondary round.
EV maker Ather Energy reports a 29% year-on-year jump in operating revenues in the fourth quarter, narrows losses by 17%.
Chinese e-commerce major Alibaba's group firm Antfin is likely to sell Paytm shares worth 2,200 crore rupees via block deals. According to Money Control, Antfin is likely to sell near 4% stake in the fintech firm at a floor price of a little over 809 rupees apiece.
Healthy snacking brand Family backs $40 million. The Series C round was led by L. Catterton with participation from existing investors DSG Consumer Partners. The funds are going to be used for capital expenditure, expanding distribution channels, and investing in product formulations.
Ride-hailing firm Uber launches Courier XL in the country, which will enable users to send large goods. Uber Courier XL service is currently in Delhi NCR and Mumbai.
Amazon-backed M1 Exchange raises $10 million from Filter Capital to support its digital supply chain finance operations. The firm has raised over $47 million to date.
Well, those are the headlines we've been tracking for you this evening on What's Brewing. Motilal Oswal and Raamdeo Agrawal have each invested $50 million in Zeppto in their personal capacity. And that's not all. Motilal Oswal is also gearing up to lead a $250 million secondary round in the startup. Shilpa Ranipeta is here with the details. Shilpa, take us through what you're picking up from your sources.
Well, more funds coming in for quick commerce startup Zeppto. We're given to understand from sources that Motilal Oswal and Raamdeo Agrawal, the co-founders of Motilal Oswal, have in their personal capacity invested $50 million each, a total of $100 million in Zeppto. Now, remember, this is not Raamdeo Agrawal's first personal investment either. He invested about roughly $15 million in late last year in 2024 as part of a larger round, and also an undisclosed amount earlier in August 2024 as well. Now, apart from this, we're also given to understand that Motilal Oswal, the company, is also preparing for a secondary share sale in the company worth about $250 million. It will lead this round where they are looking to shore up funds from these domestic investors and then use that to buy international investors. Now, remember, this is part of Zepto's larger effort where it is looking at increasing domestic ownership, which is currently roughly at about 20 to 30% now, and it wants to show that up much further, and these funds will be used to buy shares back from international investors. Now, remember, some of the international investors currently in Zeppto include the likes of General Catalyst, Nexus Venture Partners, Stepstone Group, Y Combinator, Goodwater Capital, Gladebrook Capital, amongst others. And the company also, last time when it raised funds, had very clearly said that as it heads towards public listing, as it heads towards an IPO, it wants to ensure that it is a fully domestic company, and that is the strategic direction that the company is going in through these rounds. Now, the last round, if you remember, which was about a $350 million round that Zeppto raised in November 2024, which was again led by Motilal Oswal Private Wealth. There also it saw a whole host of domestic investors coming in, including the likes of Haldiram. So yes, as the company moves ahead with its plans for the IPO, and as the quick commerce space, the competition heats up rapidly, Zomato is raising funds continuously to be able to become a completely Indian-owned company.
All right, Shilpa, we'll leave it at that. Thanks very much for joining in. Now, in What's Brewing on Startup Street today, hyper-local logistics startup Porter has successfully closed its Series F funding round that was led by Kedara Capital and Wellington Management in a mix of primary and secondary exits to shareholders as well. Now, while the company did not disclose the amount, we do understand Porter has raised about $200 million at a valuation of close to $1.2 billion in this round. Now, Porter says it is going to use this money to expand operations across multiple cities for team expansion as well as for tech developments. But for more on this, joining me now is Uttam Dikka, who's the co-founder and CEO of Porter. Uttam, congratulations on this large fundraising. You've not disclosed the amount, but could you give us any more details into how much of this 200 billion was primary investment into the company and how much of it was actually just secondary exits by investors?
So, I think we have chosen as a policy not to disclose it, but I think both were significant chunks. So yeah, I think it's more or less, we would not like to disclose exactly how much was primary and how much was secondary.
All right, we will get back to that later, but how will you deploy this money, which we understand is pretty large? How are you going to split it across key areas like, when you're talking about expansion, tech investments, what will you focus on?
So there are three primary areas where this funding would help us to go. One of the first is it would help us take our service to more users, which would mean we'll expand to more cities, more areas and geographies. Second, it would also help us enhance the service mix. So currently we cater certain user needs. It would also expand our association with user, where we will help to, where we'll add more and more service segment and help our users, SMEs, to move goods from point A to point B much more effectively. This funding would also help to build the density of the existing network far better, and which would help us to up the experience of our users. Because once you have a dense network, your fulfillment of service becomes better, your ETAs become smaller, and your price becomes better. So I think these are the key areas which this funding would enable us to do.
Okay, in FY24 was your last disclosed number. There was a jump in revenue to about 2,700 crores. You also managed to narrow losses. How did the year that's just gone by, FY25, shape up? And with this new money in your coffers for expansion, what kind of earnings boost should we expect going ahead?
So the growth momentum has been good for last couple of years. If you look at our trajectory, Porter has been one of those brands which has not, it's like a marathon mindset where we have compounded consistently for last 8-10 years. We never had a phase where we have grown 10x in a year and then not grown year after that. So I think it's a marathon mindset. Typically, I think that mindset is going to continue. Can you repeat the question? Sorry, I missed the question. Last part of the question.
Yeah, the other part of the question really was, what kind of earnings boost should we expect and how FY25 shaped up for you?
So in FY25, the same momentum continued. We have grown north of 50% last year. We were supposed to reach quarter level profitability in one of the quarters last year. We are happy to report that we have also been able to achieve that as well.
Okay. Uttam, there's been a lot of activity in this segment you operate in recently. I mean, you have players like Swiggy, Genie that are folding up services on one hand, and then today you have the likes of Uber expanding their courier services with Uber XL. Just give us a sense of what kind of opportunity you're seeing in this current environment to capture a larger share of the market. For instance, you've been expanding operations by running this intra-city courier service on two-wheelers. What more could we see from Porter?
So if you look at our current assortment of services, our objective is that anything which moves from point A to point B within a city, Porter should be the right company to enable that journey for SMEs and retail users. In our journey today, we have been able to, and if you look at our monthly transacting base, it's already north of 3 million per month, and it's powered by roughly around 3 lakh gig workers who are depending on livelihood on us. And again, I think it's a fairly nuanced industry because goods movement is heterogeneous, and it's very important to solve for the right use cases. There are smaller shipments which require speed. There are bigger shipments which require handling. So it's a fairly nuanced industry, and one would understand the know-how to crack this well. Over the years, we have compounded well. It demonstrates that how we have understood the market well and how we have understood the use case of the users well.
All right, you've understood the India market, Uttam, but what about the other countries? There are 2 countries you've expanded to. What have you learned from those international forays, and does the funding signal a more aggressive global push or a deeper consolidation within India first?
So India remains our key focus area. We are committed to build the business more deeply and more extensively in various cities of India.
Okay.
International is again an important strategic bet for us. The markets which we are currently focusing in our international expansion are markets which has a very high SME contribution to their economies. These are typically developing countries or which has large trader communities. For example, markets like Dubai, Bangladesh has been good for us, and a couple of other markets which we are catering to, scouting to, and I think that's what our international plans is about.
All right, Uttam, we've run out of time. Just the final few seconds. What kind of emerging technologies, if you could briefly tell us, do you see fundamentally reshaping logistics in the next few years? And, how is Porter positioning itself in that?
So, again, we see a lot of use of AI, which would come in across tech platforms. How it would translate to us is that the way the customer books a vehicle today, I think that journey can be simplified with the use of AI. The way we allocate or find the right partner for the service can also be shaped with the help of AI. And again, I think whenever you have complaints and escalations, we have to take a lot of real-time decisions. I think those decisions can also be taken into consideration with the help of AI. The other thing which we feel, again, I think it's an opportunity area for us to become better. Today, when we move goods, there is, especially within a city, you need a full truckload which goes from point A to point B. One of the things which we are chasing in order to make our service much more affordable for our users is how we can make sure that can we club goods of 2 users into 1 vehicle as a pilot, and this would help to reduce prices further for our customers.
So bring in more efficiency through AI. Uttam, on that note, thanks very much for your time here today on CNBC-TV18. It was a pleasure speaking with you.
Thank you. Thank you for the opportunity.
And moving on, tech-led commercial design startup Flipspaces has raised $35 million in a fresh funding round led by Iron Pillar and supported by key investors. With a proven profitable model and over 65% annual growth, Flipspaces is transforming the fragmented commercial interiors market by offering SMBs and large enterprises an integrated technology-driven design and build solution. As the company expands aggressively into the US, UAE and beyond, this investment will fuel their technology innovation, brand leadership and global growth ambitions. Today, we dive into how Flipspaces is reshaping the future of commercial spaces worldwide. And joining me now to discuss this further is Kunal Sharma, the founder and CEO of Flipspaces. Kunal, thank you so much for taking time out and being here with us today on the show. Now, the SMB segment accounts for about 60% of the commercial interiors market, right? And Flipspaces has sort of positioned itself as a tech-first, one-stop solution for this audience. So what unique pain points are you addressing for SMBs that traditional players have failed to solve? If you could sort of take us through what's on offer.
Sure. Thanks first and foremost for having me on the show. As you correctly pointed out, the SMB segment has seen an upsurge across the last 30 years. Where SMBs or SMEs today across India and North America and UAE, which is the territory that we're looking at, they want more and more aspirational offices. They want offices or cafeterias or commercial spaces, whichever segment we're talking about. They want a piece of their personality or a piece of their brand to actually reflect in the way that the spaces are being built out. At the same point of time, legacy supply, which is traditional interior designers or traditional interior design and build outfits, have not been able to keep pace with the kind of design aspirations that this customer base will typically have, right? Which is where Flipspaces comes in as an integrated one-stop brand, looking at the entire design and build journey, right? And in doing so, the fundamental tenets of customer delight that we look at is whether the mandate is being completed in time, because most of the SMB properties or commercial properties that they pick up are leased out properties. So it's important that they finish off within the rent-free period. It's also important for SMBs to finish off in cost, which is the second parameter. And third is obviously what is the kind of quality promise that you come across with. So I'd say time, cost, quality are the three cornerstones of customer delight in the SMB interior design and build category.
Time, cost, and quality is what you're talking about. Now, with this $35 million funding round, right, what are your immediate priorities for technology enhancement and brand leadership? And how will, sort of these investments differentiate Flipspaces in the global commercial interiors market?
Look, for us, and I'm glad you asked that question, right? So for us, it's important that Flipspaces is not just looked at as an interior design and build venture. Somewhere we want to establish ourselves as the template on which commercial design and build should happen, right? And that also kind of defines our focus of where the deployment of fund is going to be. So the first deployment of fund is going to be on continuing developing on our technology moat, because we genuinely believe that technology is the skeleton on which the entire workflow, which is the internal workflow, and also the differentiation as far as customer delight is centered around tech. So tech is going to be deployment number one. Deployment number two is obviously going to be other geographical areas, except for the three locations where we're primarily present. So currently within India, while we're present across West and South India, in the US, we are only present in the East Coast. So I think we'll be looking at more number of cities for expansion across India and North America. And of course, we're also now looking at UAE as a market and several other international hubs. So geographical expansion is going to be deployment number two. Deployment number three is to actually look at inorganic acquisitions where we can merge or buy out legacy outfits which have a similar kind of mindset as we continue moving towards a public market listing in the next couple of years. So I think tech growth and inorganic opportunities is how I would summarize the deployment.
Sure. And, Flipspaces has achieved over 65% in CAGR in the last 4 years, while also maintaining profitable execution, right? So what are the key operational strategies behind this capital-efficient growth, and how do you plan to sustain it? If you could sort of take us through where you hope to close this year also when it comes to revenues, are you on track to stay profitable?
Look, we often joke about the fact that we're the kind of entrepreneurs who don't sleep well at night if we're burning too much money. So I think capital efficiency is ingrained as a part of our entrepreneurial DNA. I believe on the metrics, as far as what has led to a profitable growth, except for the mindset, and the mindset is that it should never be growth versus profitability. It has to be growth with profitability, right? That being said, I believe our average order values have doubled in the last 3 to 4 years, providing us very, very strong operating leverage. Repeat business has continued to be 50% plus of the entire GTM strategy, which is a testament to a lot of customer love for the kind of tech-led services that we're providing, which has again led to reduction in CAC. And finally, there's a lot of economies of scale that has come in from being able to scale up and being able to target enterprises across India and US. So I would say increasing order values, CAC going down, and better procurement has been one of the reasons why we have continued to grow at the rate and while sculpting our EBITDA or our bottom line.
Sure. And, one more thing that you pointed out is that you are looking at inorganic growth. If you could sort of quickly tell us and take us through the kind of companies you're looking at. Are you in talks with anyone? What's the acquisition roadmap for Flipspaces?
While it will still be early days, to be honest with you, we have initiated conversations with a couple of interested parties. Our idea as far as acquisitions is concerned will be twofold. One is to look at enterprises who are doing integrated design and build, but probably without any technology leverage in a geography where we are currently not present, right? So probably, latching on, or these organizations latching on with Flipspaces, where we can bring in our tech-led template in order to expand their EBITDA and also to bring in more structure, to the process, would be one kind of organizations. At the same point in time, we would gain from the legacy of work that they have created in a new geography, right? So this would be on the revenue side. The other kind of acquisitions would be in categories that are adjacent to us, right?
Right.
In India and US, we happen to be very strong in the offices and cafeterias and restaurant segment. There are other commercial categories where we would want to look at acquisitions.
All right, Kunal, we're completely out of time, but thank you so much for joining us on the show, and we wish you all the best going forward.
Thank you. Likewise. Thanks a lot for having me.
Note, it's time Into a short break, but coming up, skincare brand Deconstruct reports a 10x surge in revenue and sets its sights on 500 crore rupees by FY26. We speak to the founder on the other side. Stay tuned. Welcome back to Startup Street. Science-backed skincare brand Deconstruct has reported a 10x surge in revenue for FY25, along with achieving double-digit EBITDA profitability. The brand is now setting its sights on 500 crore rupees in annualized net revenue by FY26. And to walk us through what's fueling this momentum and what's next for Deconstruct, I'm now joined by its founder and CEO, Malini Adapureddy. Malini, welcome to Startup Street, and congratulations on an outstanding year, a 10x revenue jump and EBITDA profitability. Tell us, what were the key drivers behind this breakout year for Deconstruct?
Thanks, Shruti, for having me on this program. So I think firstly, what actually helped us to this growth is like crazy amount of focus that we've actually done on everything. So we've always had around 40 SKUs, but then we actually like took a step back and said that, okay, let's just focus on maybe 3 to 4 of them to grow. Focus on resources that are being utilized internally as well. Focus on using tools, data, and tech to kind of get a lot more or a better output, and focus also on channels. So we were actually going out on all the channels. So we just took a step back and said, let's just concentrate on 4 to 5 of them, and let's just grow the brand on channels that will kind of with this focus growth on SKUs, understanding the consumer very, very well. So we just went forward with it. So I would rather say like just one word that's kind of helped us to, get to this space is definitely focus, and doing more with fewer products, fewer, channels, and very sharp positioning on the target group as well.
Okay, clearly the strategy has worked out for you. You've touched 200 crore rupees in annualized net revenue and are now aiming for 500 crore rupees by FY26. Malini, what is the strategy to get there? Will it come from product innovation, deeper market penetration, or something else?
Sure. I think product innovation or product, being obsessed with product as a DNA has always existed for us as a brand, and probably that's the reason why the brand got received very well by the consumers. That's something definitely we will be putting a lot of resources, we'll be putting a lot of time on as we go forward, because I feel that's the base, that's the table stakes for us to get to the next level for sure. And we will will definitely be putting in, a lot of monies over there. Second is on channel expansion. Now, like last year, we've talked about how we actually went very, very focused on channels. Now going forward, I think two of the things which we have not explored until now is something we'll be doing a lot more of. Is one is expanding into the offline retail. That is something we have not touched. And number two is expanding into international markets. So these are the two things, which we will be doing a lot more on, and basically what will fuel the growth.
Absolutely, and we'll discuss the global ambitions in just a bit. But tell us, how do you consistently identify strong product market fit with customer acquisition costs coming down and marketing ROI improving? What's working for you in today's crowded D2C landscape?
I can't actually stress the importance of being obsessed with the product and the product quality, like every product, every batch that comes out. So that's definitely a must, I would say. And that's something we've maintained and we got the consumer love. Secondly is basically, knowing your target group very well, like who are you positioning your product for? While we are a science-backed brand which talks a lot on efficacy, but what makes us stand apart in this crowded market is that a promise of being effective while also being gentle. And, that promise comes out in every product of ours. And we also know who's the target group who actually needs something that's just not effective while also being gentle. We know that target group also sharply.
You recently raised 65 crore rupees from marquee investors, included L'Oreal's Bold, VC and V3 Ventures. Now, what does this fresh capital enable in terms of product and market expansion?
Sure. So I think from a product innovation perspective, as I said, opening up a lot more labs, doing extensive testing, more testing than what we have done before on our products, and of course also launching newer categories. Number two, as I talked about, is international expansion and offline retail. These both channels are going to be more capital intensive. So these are the two places where largely the monies will be going into.
Okay. Malini, with global beauty giants now backing emerging brands, what does L'Oreal's validation mean for Deconstruct? And is an acquisition a possibility down the line?
So definitely L'Oreal's VC arm Bold investing in us is a great validation that we are on the right track, that we are doing the right things. That's something not to take away from, that's been really helpful for us as well internally as a marker that, okay, we are have been doing things the right way. From an acquisition perspective, I think the market for beauty and personal care India has just started happening, and we are riding on that early wave. And as I said, we just work with 3 SKUs, hero SKUs at this point in time. The idea is to go deeper into the market, penetrate more into the market, and think of any other plans, for the future with respect to acquisition for sure.
All right, one final question before I let you go. Like you mentioned, you're eyeing global markets. What's your approach to international expansion? Will you replicate your India model or tailor it for each market? And what